I'm Rick Edelman, and this is The Truth About Money. On today's show,
Just have a question about investing overseas.
Children begin starting to make assisted financial decisions at age 3. Who, after all, is picking the cereal?
And he makes a lot more money selling that annuity product than he would recommending something that's more appropriate.
yeah, he makes
for you.
about 10 times more by recommending what he's recommended.
When I came in as president of the Texas Rangers, I had no prior experience in the front office of Major League Ball Club.
That's all coming up right here, right now, on The Truth About Money. I have a very simple question on investing for you. You own equal amounts of 2 investments. One goes up and the other goes down. What would you do? We asked that question of a bunch of people, and here's what they told us.
I think it would be smarter to hold on to the one that went up, and I'd probably sell the one that went down.
I'll sell the one that went up.
I don't think I would sell either, because if I had 2 stocks and I had done research and I wanted to own those stocks, so unless the underlying reason that I had bought those stocks changed, I wouldn't sell either.
What would you do if you owned 2 investments and one of them rose while the other fell? Your gut is probably telling you to sell the loser and buy more of the winner. Wrong. If that's what you want to do, you're falling victim to something called pattern recognition bias. That's the belief in past performance, believing that you see trends that really don't exist. In this case, you're choosing favorites based on how they did in the past, assuming that how they did in the past is how they'll do in the future. Bad idea, because investments don't work that way. If they did, everyone would simply buy last year's winner and everyone would own the same thing all the time. It doesn't work that way, does it? Sports fans know that last year's winner of the Super Bowl or World Series is not guaranteed to be the winner next year. Weathermen know it too. Just because it rained yesterday doesn't mean it's going to rain today. So when you own a variety of investments and one rises and another falls, the smart thing to do is to sell some of the winner and buy some of the loser. Want me to say that again? Yeah. Sell the winner, buy the loser. I know, you think I'm crazy. Imagine coming home from work and saying to your spouse, "Hey honey, you know that investment that just made us a fortune? I just sold it. And you know the one where we lost our shirts? I bought more." Imagine the reaction you would get. But you know what? That's exactly the idea. It's called rebalancing. And it causes you to sell assets while they're higher in price and buy assets while they're lower in price. Think about it. If you only sell while prices are high and you only buy while prices are low, well, you see how profitable this can be over the course of your lifetime? Rebalancing is a vital element to a successful investment management program. If you haven't rebalanced your portfolio lately, take a look at doing it now. And if you need help with rebalancing, talk to a financial advisor. When I do Q&A with my live seminars, you never know what the audience is going to ask. Let's take a listen.
Hello. I have 2 young children, ages 3 and 5, and they're starting to become aware of money and what they think they can do with it. Do you have any recommendations on when to start introducing children to more money management concepts?
At that age, 3 to 5 is exactly the right time. Children begin starting to make assisted financial decisions at age 3. Who, after all, is picking the cereal? And in what store is it that children are making their first financial decisions? It's not a toy store, it's the supermarket, because they're with mom or dad and they're shopping and they're pointing and selecting and so on. In fact, if you ask the typical 6-year-old, where does money come from? You know what the most common answer is? The ATM. Yes. They watch you walk up to the machine and push buttons and money comes out. So you need to have a conversation with the children about money as soon as they are able to understand the nature of the conversation. By that I mean they're communicative. So as you're teaching the children to count, use coins, not marbles. As you're teaching the children to read, have them read books and children's books that have to do with money. As you start to give the children an allowance, start to associate that allowance with financial themes. For example, we would like to recommend that children understand with allowances 4 important issues. First, with that allowance, they get to spend some of it immediately on anything they want, to demonstrate that with money comes opportunity and the luxury of spending that money. Second, they need to save some of the money for something that they can't afford at the moment with the available cash, to learn delayed gratification, the value of saving for the future. Third, they need to understand that with the opportunity of money comes an obligation, and they need to give some of the money to those who are less fortunate than themselves and let them determine who the needy is. It might be a friend down the street who isn't as well off as you, or a charity or church or other religious organization. And finally, fourth, my favorite, they need to pay taxes on that allowance. They need to understand that they don't get to keep 100% of what they earn. You need to withhold 20 or 30% of that allowance in taxes. And what you do with that money is you set it aside in an account, and you do that for 15 years, and when they're ready to buy a car, you hand them a balance of thousands of dollars. You'll not only be a hero, you'll have demonstrated the value of long-term savings and investing. Spend a little, save a little, give a little, and tax a little, and start having these conversations with children at very young ages.
Hello, Rick. I just have a question about investing overseas. What are some ways that the average investor, or what type of products are out there that we can utilize to invest overseas?
Great question, because it's very important that we recognize this is now a global economy. And whether we like it or not, there is a huge amount of capitalism going on in other parts of the world. The BRIC nations, which are considered the very powerful ones, Brazil, Russia, India, and China, are leading the way. Let's not forget, of course, Western Europe, which is the second most dominant economy in the world after the United States on a collective basis. And of course, there's Japan, one of the most powerful economies in the world as well. So we need to recognize that it is a global economy, and we need to invest accordingly. There are 2 ways to do it. One way that you can invest internationally is by buying individual stocks. They are called ADRs, American Depository Receipts. I mean, if you have a stock of a company that is based in Japan, you can't buy it in the United States because that stock doesn't trade in the US, it trades in its home country. So the company will have a proxy called an ADR that enables you to buy that stock here in the United States. But we don't like the idea of buying individual stocks because it's very risky. You don't really know what the fortunes are going to be with that individual company. So we prefer to invest for our clients with baskets of stocks. Instead of trying to choose the individual company or the individual country or the individual continent, what we do instead is do it all. So we provide for our clients an approach that I think would make most sense for you, which is to use an exchange-traded fund or an index fund that buys hundreds, even thousands of stocks from foreign companies and foreign countries and foreign continents. There are a wide variety of international and foreign ETFs and mutual funds available that enable you to do this at extraordinarily low cost. With a very low investment amount, with a very small amount of money, you can gain exposure to the global economic marketplace, and it's a great approach to do. Now, you have to keep in mind there are 2 very big problems when you're dealing with foreign investing, whether you're buying an individual stock from overseas or a basket of stocks through an ETF. One problem is called sovereignty risk. What happens if the country has a revolution and everything gets nationalized? Can you think of any countries where that might be an issue? So you have to beware of political instability, which is something that we in America don't really give a lot of thought to because we are such a stable place to live. The second problem you have to watch out for is currency risk. Because when you're buying a security that's overseas, you're using dollars to buy something that trades in another denomination. Maybe it's the yen, maybe it's the euro, who knows what it might be depending on the nation. And because of that, you're not only dealing with stock market volatility, you're also dealing with currency volatility. It's a double-edged sword. If currency rates go against you at the same time the market goes against you, your losses could literally be double. Of course, the gains can be double too. That's why it's so volatile. So for both of those reasons, we generally recommend that you limit yourself to no more than 20% of your total assets be invested internationally. But for most people, the number should not be zero. It should be somewhere between 5 and 20% of assets, depending on your situation.
Great. Thank you very much.
My pleasure.
Here's your chance to prove you're a financial whiz. It's our quiz of the day.
True or false? Getting a tax refund is good news. Stay tuned for the answer.
One of the things I like doing best are taking questions on my live weekly radio show. A frequent topic is the question of what account is best for retirement savings. Check this out. Let's head off to Miami, speaking of nice places to be. Mike, welcome to The Truth About Money. How are you?
Great, Rick. Hi. Thanks for taking my call.
Sure.
Reason I'm calling is I changed jobs recently, so I have the opportunity to roll my 401k over into an IRA now.
Mm-hmm.
And my financial advisors recommended a variable annuity with one of those annual 8% guarantees within a traditional IRA.
And why did he recommend that?
Educated second opinion as to whether or not I'm better off doing that or just popping them into mutual funds within a Roth and doing it myself, like with Vantage or something.
Mike, why did he recommend that investment?
Well, because of the down guarantee, the 8% guaranteed to get an 8% return regardless of market performance each year.
And he's guaranteeing an 8% return over what period of time?
It's over the lifetime. It's not something that he's guaranteeing. It's built into the contract. They basically give you.
So what, Brandon?
Yes, Mike, I think you might be confusing it with a withdrawal benefit, because I don't think there's a product out there that can literally guarantee you're going to earn at least 8% per year over time.
Right.
Yeah, it is a withdrawal benefit.
Okay.
I can't walk away with it. I get it when I start taking it.
Understood. How old are you, Mike?
30.
You're 30 years
Wow.
old. Okay, well, you're not dealing with an independent, objective, fee-based financial advisor. You're dealing with someone who earns commissions by selling annuity products.
And he makes a lot more money selling that annuity product than he would recommending something that's more appropriate
Yeah, he makes
for you.
about 10 times more by recommending what he's recommended. It does not make any sense, Mike, for you to take money from a retirement account and invest it inside an annuity for one simple reason. The benefit of a retirement account is that the money grows tax deferred. The benefit of an annuity is that the money grows tax deferred. Well, you already have that benefit in the retirement account, which means you're not gaining anything by putting the annuity inside the IRA. Therefore, the industry comes up with, okay, we need another benefit. So we'll offer this guaranteed 8% income stream for a period of years. In case the market falls, you can at least get your money back. That's the promise. But you're only 30 years old. This money's going to remain invested for 30 plus years. Do you really believe that the stock market 30 years from now will be lower than it is today?
No, I expect it to be a lot higher, actually.
Exactly. And therefore, you should not choose the annuity, not only because you don't need the guarantee, but more importantly, because that guarantee is very expensive. And the high cost of the guarantee, the high cost of something you don't need, will put a drag on the profits you would ultimately earn. Therefore, this is a really bad piece of advice. It is highly controversial. The regulators don't like the idea generally when people recommend annuities for retirement accounts because it's a redundant strategy, doesn't serve your best interests, but saddles you with dramatically higher costs. So not only should you not accept the recommendation, it puts into severe doubt the veracity of the person who made the recommendation in the first place.
Getting a tax refund is good news? False. Getting a refund means you overpaid the IRS last year, and you gave the IRS an interest-free loan.
Off to the Eastern Shore, we're talking with Dick. Dick, you're on The Truth About Money. How are you, sir?
Oh, great, and greetings from the Eastern Shore. My wife and I just reviewed a CD presentation, on an investment instrument that seems to be this company buys a paid-up life insurance policy on some old sick guy, and then at a deep discount, and then they're willing to sell you a fractional share of that. Can you tell me what you know about that? Is he real secure?
So you buy a life insurance policy of an old sick guy and hope that he dies quickly.
That's right.
So that you can cash in on his death benefit.
Well, the company does. You're buying a fraction of what this investment.
Dick, bottom line is you're hoping this guy dies and that he dies quickly. And you might even, visit the nursing home and help him along. This is called this is called a life settlement.
Right.
And it is highly controversial. In fact, many states have made life settlements illegal. They are seriously disrupting the fundamental actuarial data of the life insurance industry, which has the impact of raising the costs of life insurance for everybody. Some people consider this rather ghoulish because you're profiting on the death of a stranger.
Well, not only that, would you want to have someone who had a vested interest in your demise?
And these investments have not performed as advertised. Because what's happened is the company that buys the policy, Dick, the company that's approached you, is making a judgment on how long people are going to live. And in the past, and this has been all over the news in the last 6 months, the judgment, how long somebody's going to live, hasn't come to fruition. Right. In other words, if they're only going to live 3 years, the payout, Dick, how much money that you would make as an investor might be pretty high. But lo and behold, if the person whose life the insurance policy is on lives 10 or 15, your investment is not going to perform as they're advertising. And that's what's been happening with these types of investments.
So, no, Dick, this is not something that we would recommend you get involved in. His career record of 7 no-hitters hasn't been topped by any Major League Baseball player. He is, of course, Nolan Ryan, Baseball Hall of Famer and now president of the Texas Rangers, leader of the group that bought the team in 2010 and took them to the World Series. Nolan is as comfortable in the boardroom as he is in the bleachers, and we caught up with him at the team's spring training camp in Phoenix, Arizona. Nolan, welcome to the show.
Thank you, Rick. Pleasure to be here.
You began your baseball career in the 1960s. Baseball player salaries were radically different back then compared to today. Tell me what that was like, dealing from a salary perspective in your early part of your career to what you see today.
Well, we didn't have visions in those days of where salaries would go and the escalation that we've seen in salaries since free agency came into the game. And baseball was very tightly controlled by ownership of baseball and by Major League Baseball, and what we've seen now is the swing of the pendulum go the other way, and that things favor the players much more now than they do management. And what we're trying to do is get there be a balance there, the situation where Major League Baseball and management can deal with the circumstances and make a profit, and where the players and the Players Association feel comfortable with what they have accomplished for the players and future players coming up. And so I think there's getting to be more balance there.
Do players today make too much money?
No, the one thing that I believe in, if somebody is paid for performance and they perform to that level, they don't make too much money. Where you get into situations where you have to guarantee contracts, you have long-term contracts, and players do not play to the level of what they're being paid for, then that's where you have an issue with it, because you have all this money tied up, you're not getting the performance that you need for the organization to be successful, and it keeps you from being able to make other moves, and so it becomes cumbersome, and you're not very successful when you get into those situations.
You've made the transition from player to management. Do you find it a challenge to recognize your new role when you're dealing with player negotiations?
Well, the whole role that I'm in, when I came in as president of the Texas Rangers, I had no prior experience in the front office of a Major League Ball club, and so it was a learning curve for me. I'd been involved in minor league baseball and involved in the development side of it on a limited basis, and so I understood that aspect of it, but the day-to-day operation of a Major League Ball club, I had no previous experience in, so it was a big learning curve for me. And then with the financial problems that we had as a ball club and organization, it even compounded it, but it's been a great experience. The 3 years I've been here, I've learned a lot, and I wouldn't I wouldn't trade those experiences because I look at it as part of life's experiences that I've gained a lot of knowledge and experience from.
What advice would you give players today? It's lots of anecdotal evidence that professional athletes squander much of their wealth.
Well, there's two things I advise them on. One is what a unique opportunity they have and try to make the most of that opportunity. And two is that they are in a unique opportunity from the financial situation that they have an opportunity to make more money than they ever thought they would. And they're not qualified and they're not prepared to handle that. And so what they need to do is find the best people they can find to help them, advise them in what to do with their money, so that when I was a believer there's life after baseball, and that you should prepare for that because you're not going to always make that kind of money, and there's no way to predict when your baseball career is over, and so you have to start preparing for those things.
Do you find that financial stress impacts their performance on the field?
Everything impacts their performance on their field, their relationships within their families, financial stress that they're under, how they feel physically, and so all those things come into the clubhouse and impact the ball club. And so the less of those stresses that we have, the better off we are. And because baseball is a day-to-day game, it's not once a week like football where you prepare for it and they're able to go out there that day and focus. They live this on a day-to-day basis, and so because of that, there's more challenges of those kind of stresses not coming into play. You have to try to prevent them from having an impact on your ball club.
How do you do that?
Talking to your players, through supporting your players, that them understanding that and trying to get them to realize when they come to the ballpark they have a job to do and they need to focus and not let these things, and it's hard to do it. You have to do it through experience. And so when you have a young ball club like ours, you're more apt to have those kind of problems. Where a veteran ball club, people understand it, they understand what's important, what they need to do, they have the mental discipline to do it. And so there's things that come into play with a veteran club because they're capable and prepared more to handle it than a young ball club. So when you have a young ball club like we do, you're more prone to have those things interfere with what you're doing.
We've talked about player salaries and the goal of obviously the team management to make a profit. What about the fans? So much of professional sports is now priced beyond the ability of an ordinary family to come off into the game.
Well, our game, we haven't lost sight of our fan, and we still think that it's affordable family entertainment. We have nights, whether it's kids are free on Tuesdays, $1 hot dog night on Wednesdays. We have a certain segment of tickets that are discounted for families. So we have not lost sight of that. Obviously, there's always pressure on generating more revenue because salaries go up, costs go up. And so you have to do a balancing act. And so that's what we try to do. But we do believe, that the customer, without the fan, we don't exist. And so our attitude towards our fans and customers is that we want to make that the most pleasant, enjoyable opportunity when they come to the ballpark. That experience, when they walk out of there after the game, win or lose, they were glad they spent their money and came to the ball game.
Nolan, thanks so much for joining us.
Rick, my pleasure. Good seeing you.
Thank you.
Before we go, remember, when leasing a car, you're not buying the car, you're renting it and everything inside it. And that means you need to negotiate the cost of all the options, the navigation system, Bluetooth, those fancy rims, before you agree to the car's lease price. If you don't, the dealer will tack on the full cost of the options, even though you never really get to own them. Remember, when leasing a car, don't buy options that you're only renting. And that's the truth about money. I'm Rick Edelman. Thanks for watching.